stocks, or real estate? Where should your money actually sleep? That single question just stopped thousands of people mid-scroll. Today we're doing something most finance channels refuse to do. We follow two ordinary guys, Alex and Jordan. They both started with the exact same $50,000 10 years ago. Alex went the classic stock market route. Jordan went all in on real estate. We're running the complete, no-fluff, brutal math. Across 10 years, 20 years, and 30 years. Taxes, inflation, crashes, cash flow, leverage, maintenance, opportunity cost, everything. By the end of this video, you'll know exactly where your money should sleep if you want to build real, lasting wealth. Alex took his full $50,000 and put it into a low-cost S&P 500 index fund. He's been adding $500 every single month, like a disciplined 401k saver. Historical average return, including dividends, right around 10%. Jordan used his $50,000 as a 20% down payment on a $250,000 duplex. He lived in one unit rent-free and rented out the other side right away. Pause the video for 5 full seconds. Be honest with yourself. Which one do you think is richer today? After exactly 10 years, Alex's portfolio has grown to $218,000. It's clean, completely passive, almost zero effort. Jordan's duplex is now valued at $385,000. His mortgage is down to $178,000, giving him $207,000 in equity. On top of that, he collected $450 in positive cash flow every single month, while living rent-free the entire decade. Jordan didn't stop at one property. In year 4, he used part of his cash flow and a small refinance to buy a second rental. Alex simply kept adding his $500 every month. Same discipline, completely different results. Let's jump to year 15. Alex, still adding $500 monthly at 10%, reaches roughly $380,000. Jordan now owns 2 properties, with $520,000 in combined equity and $1,100 per month in positive cash flow after all expenses, vacancies, and repairs. By year 20, Alex is sitting on approximately $580,000. Still very solid for a pure stock investor. Jordan, now with 3 properties built through smart equity recycling, holds $1.05 million in equity and generates $1,800 in monthly cash flow, enough to cover most living expenses. Same starting amount, same monthly discipline for 10 full years, $580,000 versus $1.05 million plus actual monthly income. Let that sink in for a moment. Taxes tell 2 very different stories. Alex has been paying capital gains and dividend taxes the whole time in his taxable accounts. Jordan used depreciation deductions to pay almost 0 taxes on his rental income for over a decade and can defer every major gain with 1,031 exchanges later. Inflation is the silent killer. Alex's $580,000 at year 20 will only have the buying power of about $420,000 in today's dollars at 3% average inflation. Jordan benefits 3 powerful ways: property appreciation, rents that historically rise faster than inflation, and a fixed-rate mortgage that becomes cheaper in real dollars every single year. Picture this. You wake up every month. One guy opens his brokerage account and sees red numbers flashing. The other sees fresh rent deposits hitting his bank account automatically. Which feeling do you want for the next 30 years? Cash-on-cash return is something most stock investors completely ignore. Jordan started at 9.8% in year 1 and climbed all the way to 18% by year 10 as his debt shrank. Alex's effective dividend yield on the S&P 500 stayed locked between 1.5 and 2% the entire time. The 2022 volatility test was brutal for both. Alex lost 25% of his portfolio in just a few months. Jordan's tenants kept paying on time. And in many markets, his properties actually held value or even went up because of the housing shortage. The gap isn't just growing, it's accelerating. And we're only halfway through a 30-year race. Year 25 update. Alex, with continued contributions, reaches about 950,000. Jordan, now managing 4 properties through disciplined equity recycling, sits on $2.4 million in equity and over $3,200 monthly cash flow. Federal Reserve data across decades confirms this pattern. Families who use smart real estate leverage like Jordan end up with approximately 38 times the net worth of those who stay purely in stocks and never own investment property. Right now, I want to know where you stand. Drop in the comments. Team Alex if you're leaning stocks, or Team Jordan if you're leaning real estate. I read every single comment and the split always surprises me. NYU Stern decade-by-decade analysis shows Jordan's leveraged real estate path outperformed pure stock investing in 7 out of the last 10 decades, once you factor in cash flow and principal paydown. Debt became one of Jordan's best friends. He borrowed at 4 to 5% fixed rates, while inflation averaged 3% and tenants paid the note. Alex has no safe, low-cost way to leverage his stock portfolio at those attractive rates without dangerous margin risk. Wall Street firms and big banks quietly hope everyday investors never see this kind of detailed side-by-side comparison. Full 30-year projection time. Alex ends with approximately $1.74 million before taxes. Jordan, scaling responsibly to 5 or 6 properties, reaches between $3.8 million and $4.2 million in net equity, while still enjoying strong monthly income that can cover all living expenses. After adjusting for realistic taxes and inflation, Alex's true purchasing power lands near $1.25 million. Jordan's lands near $2.9 million. A staggering $1.65 million gap created almost entirely by leverage, forced equity buildup, tax advantages, and cash flow compounding. If your money isn't actively building equity while you literally sleep at night, you may be leaving life-changing wealth on the table. Let's talk real-world friction. Jordan dealt with 2 nightmare tenants, a $9,000 roof replacement, occasional vacancies, and 1 local market slowdown. Alex simply clicked buy on his index fund and checked his account a few times a year. Real estate is undeniably a business. Stocks are a pure investment. Jordan budgets a full 1% of each property's value every year for maintenance and repairs. Even after paying a professional property manager 8% of rent, his numbers still crush Alex's in the long run. Alex pays literally 0 for upkeep. That automatic peace of mind money hitting Jordan's account on the 1st of every month? Most people who reach this point admit it's worth more than chasing an extra 2% annual return. Looking at the 2020 to 2025 real-world window, Alex did very well with strong post-COVID gains. Jordan did even better in growing markets, delivering an average 19% annual return on equity thanks to massive appreciation and rent spikes. Opportunity cost of time matters. Jordan spends roughly 4 hours per month managing or completely outsources it. Even when we value his time at $100 per hour, he still finishes far ahead of Alex. If you genuinely hate dealing with people, repairs, and management, then Alex's pure stock path is probably the smarter and less stressful choice for you personally. Inheritance planning is another huge advantage. Jordan can pass his properties to heirs with stepped-up basis that essentially wipes out decades of capital gains. Alex's heirs will owe full capital gains tax on every dollar of growth. Liquidity is the classic trade-off. Alex can sell any portion of his portfolio in seconds. Jordan needs 45 to 90 days and pays 6% in transaction costs. But he can use 1,031 exchanges to defer taxes potentially forever by continually trading up. At the end of the day, your brain doesn't just care about total return on a spreadsheet, it cares about actual sleep-at-night money. Let's run a 2008-style crash simulation. Alex lost roughly 50% temporarily and took years to recover emotionally. Jordan's leveraged owners who kept their tenants actually built equity faster during the recovery phase because prices bottomed while rents remained relatively stable. On the tenant risk side, Jordan survived 2 rough months of vacancy and still continued building equity through principal paydown. Alex never faces tenant drama, but also misses the powerful forced savings mechanism that real estate provides. If you're still watching this deep into the video, you're clearly not an average investor. Most people tap out at the first scary chart. The smartest long-term approach many high net worth people eventually land on is a hybrid. Roughly 60% in Alex-style broad index funds for pure growth and liquidity, and 40% in Jordan-style cash-flowing rental properties for inflation protection and monthly income. This combination has crushed pure stock portfolios in every major recession since 1970. Psychologically, Jordan feels wealthy much faster because he sees his Zillow estimates rising and watches actual cash deposits every month. Alex tends to only feel it on quarterly statements and is more prone to emotional selling during drawdowns. This is exactly the kind of unfiltered math they don't teach in school. Important reminder: Jordan's own primary residence is actually his worst performing real estate investment because it produces zero cash flow. All the real magic and brutal math advantages happen in the investment properties. 2026 forward-looking reality. Interest rates are higher than a few years ago, but rents continue rising faster than inflation in many Midwest and Sunbelt markets, where price-to-rent ratios remain healthy. The window for strong 8 to 12% cash-on-cash returns is still very much open in the right locations. So, after everything, where should your money actually sleep? The leverage multiplier is Jordan's secret weapon. Every 1% of home appreciation on a leveraged property turns into 15 to 20% return on his actual cash invested. Stocks simply cannot safely replicate that kind of multiplication without taking on dangerous levels of margin debt. Risk-adjusted returns usually favor Jordan's approach for most families because real estate is a tangible asset that produces income even during recessions and forces monthly discipline through mortgage payments. The brutal math just flipped everything you thought you knew, didn't it? Common failure points for both. Alex sometimes stops contributing during market fear. Jordan sometimes neglects maintenance and watches cash flow disappear. Discipline ultimately beats both pure strategies. Final adjusted 30-year outcome after every single factor. Alex builds comfortable, truly passive wealth that most people would be thrilled with. Jordan builds accelerated, leveraged, tax-efficient, cash-flowing wealth that can genuinely change family trajectories across generations. Your money is patiently waiting for the right bed. Stocks or real estate? Where should your money actually sleep? After watching Alex and Jordan run the exact same $50,000 race for a full 30 years with identical discipline and work ethic, the brutal math no one shows you is now impossible to ignore. Alex builds reliable, simple, hands-off wealth. Jordan builds significantly larger, faster-growing, income-producing generational wealth because his money works 24/7. Tenants pay down the debt, inflation erodes the loan balance, depreciation shields taxes, and leverage multiplies every percentage point of growth. Stocks are easier and more passive. Real estate is more powerful when you fully understand the numbers, respect the work involved, and choose the right markets. Neither path is wrong. But now you have the complete, unfiltered truth instead of cherry-picked stories. If this video opened your eyes, hit like, subscribe for more honest wealth breakdowns, and drop your biggest takeaway in the comments. Disclaimer: this video is for entertainment and educational purposes only. It is not financial advice. The Alex and Jordan scenarios are hypothetical and based on simplified assumptions. Actual results will vary, and past performance does not guarantee future returns. Real estate and stocks both carry significant risks, including loss of capital. Leverage amplifies both gains and losses. Consult a qualified financial advisor and tax professional before making any investment decisions.